Hey everybody, welcome back to the show. So Morningstar for the last 3 or 4 years has put out an annual report. They call it the State of Retirement Income. They released their 2024 report just a few weeks ago. And I thought in this video we'd walk through and I'd highlight some of the interesting findings, these findings that I found interesting and useful from the report. As always, I'll link to it below this video. And so let's dive right in. Let me show you the report. Here it is. One of the sort of big things they do every year is come up with what they think is the safe withdrawal rate. That is, how much can you spend in the first year of retirement that you'll adjust for inflation each year without running out of money over a 30-year retirement? What is the safe withdrawal rate for folks retiring today? Now, remember, Bill Bengen did this back in 1994, but he looked at history, right? He didn't try to predict future safe withdrawal rates. He went back in time and said, what were they in the past? So he looked at historical data for the most part. With Morningstar in this report, what they're trying to actually do is figure out what the safe withdrawal rate is for someone retiring today. And of course, to do that, they've got to make projections about future stock and bond returns, and of course, future inflation, which they have models that they use to do that at Morningstar. Of course, you know, how accurate they'll be, well, we'll know in 30 years. But that's one of the big numbers that they come up with in this report. And so that's the question. What was the safe withdrawal rate? Or I should say, what is it today? According to Morningstar, drum roll, the answer is 3.7%. Let me show you that in the report. We're going to jump down to this page. We're page 7 and 8. Here it is. Highlighted there, 3.7%. Hopefully you can read that. I can make it a bit bigger. And so there were some assumptions. They assumed a 30-year retirement. That's important. They assumed I'll call it a very diversified portfolio, both U.S. and international stocks, U.S. and international bonds. They go through the details of that if you're interested in the report. The other big assumption they make, we're going to talk about this more in a minute, is they're going to run this through a Monte Carlo simulation, right? So they project future returns and inflation. They determine the averages and the standard deviation of those projections and then feed them into a Monte Carlo simulation. They look at this on a month-by-month basis. So recall, Bill Bengen sort of assumed that everyone retires on January 1st of each year. He started in 1926 and moved forward. What Morningstar does is say, you know, not everyone's going to retire on January 1st. Some might retire on February 1st or March, April. So they look at this on a month-by-month basis. But in order to be considered a success, they want the simulation to succeed, that is, not run out of money over a 30-year period, 90% of the time. That was their success rate that they chose. Remember, Bill Bengen said, hey, I want a 100% success rate. That's what he was using in his 1994 paper. Morningstar says we're going to use 90%. And again, we'll talk about that because they show us data for other success rates, and we'll look at that. But that's what they assumed, 90%. And they come up with 3.7%. Now, a viewer emailed me and pointed out, you know, he said, Rob, their number keeps changing. And they actually show it in a couple of places here in this report. But they did. Last year, it was 4%. I think the year before that, it was, 3.3%. Actually, we can find it real quick, I think, maybe. Yeah, 3.3% in 21, 3.8% right here in 22. And so it changes from year to year, and I think that concerned the viewer. But here's the reality. Safe withdrawal rates do change from year to year. They change from month to month. Even if we go back in history and look at what happened in the past, like Bill Bengen did, they change. And in fact, in this report, Morningstar takes a look at history. Here's the chart I'm thinking of, Exhibit 2. So this is actually based on history. You can see down here, they go back to the 1920s. And the blue line is assuming a 100% stock portfolio, the yellow line 50-50, and the red line is all bonds. And they chart the safe withdrawal rate. They're looking at this, you can see it here, rolling monthly 30-year periods with a 90% success rate. But you can see particularly with the 100% equity blue line and even the 50-50 yellow line, boy, the safe withdrawal rates, not only are they changing dramatically, but they can change dramatically in a short period of time. And in fact, let me see if I can quickly find it. I think it's right here. This really caught my eye. They said, look, the worst time for an all-equity portfolio, the lowest safe withdrawal rate occurred in mid to late 1929. Of course, that kind of makes sense, right before the stock market crash, and we're assuming a portfolio of 100% stocks. And the safe withdrawal rate was just 2.5% based on the way they calculated it. But the thing that really caught my eye was that if you just move forward just 3 years, July 1932, that's the highest safe withdrawal rate over the past almost 100 years. And that was 17.6%. So in just a 3-year period, the safe withdrawal rate, again, given all these assumptions, jumped from 2.5% to 17.6%. So yeah, safe withdrawal rates, even if you look at the historical record, not just projections like Morningstar is doing in the report, at the historical record, they change from year to year, they change from month to month, and over short periods of time, they can change dramatically. Now, I'm actually working on an article of my own about this that I hope to have published in the next week. But one thing to think about is this. Would you rather have a 2.5% safe withdrawal rate or 17.6%? And you may say, Rob, that's got to be the dumbest question you've ever asked on your show. Of course, I want a 17.6% safe withdrawal rate, except that to get that, you had to hold off on your retirement. You didn't retire in 1929, right? You waited until 1932. And what happened to your retirement portfolio over those 3 years? Well, it dropped about 90%. So yeah, you've got a 17.6% safe withdrawal rate, but remember, that's just half the equation. You got to multiply it against something, that is your retirement savings, and because of the stock market crash, you're multiplying that 17.6% against a much, much smaller number. And so something to keep in mind, and that's true as safe withdrawal rates rise and fall. As they go up, you're generally multiplying it against a smaller number, because the reason they're going up is because the market's going down. And the reverse is true. If they're down, it's oftentimes because the market has done the reverse. And so you got to keep in mind that it's not just the safe withdrawal rate, it's also what you're multiplying it against. All right, so that's sort of point number one that I wanted to mention. Now, the second thing about their findings that is maybe even more important than the 3.7% number itself, and it's what was the asset allocation they were assuming to arrive at that 3.7%. Now, they looked at all asset allocations from 100% bonds to 100% stocks. The thing that caught my eye, and here it is, was that 3.7 number comes if you have equities, stocks in your portfolio amounting to just 20 to 50% of your portfolio. In other words, you had at least 50% in bonds, if not as much as 80% in bonds will, based on their models, generate the 3.7% safe withdrawal rate. If you have more equities than that, their model shows the safe withdrawal rate going down. Now, why is that significant? Well, for a couple of reasons. First of all, when Bill Bingen did his research, he found, based on the historical record, that a stock percentage between 50 and 75% was what was ideal, that would get you the highest safe withdrawal rate. Not stocks in the 20 to 50% range. And I suppose one could say, but wait a minute, Rob, stocks are highly valued right now, and that's what Morningstar's model is taking into account. And that probably explains their finding. That's absolutely true. But remember, Bill Bingen went back to 1926. There were plenty of times between then and now when stock valuations were high, and others have extended the research back to 1871. So there have been plenty of times when stock valuations were very, very high, and the 4% rule still worked. I suppose some could say, if you look at something like the Shiller PE, it's not been this high except in the tech bubble, which wasn't 30 years ago. It was less than that. So maybe, but still, it surprises me because we've had plenty of times when stocks were very, very high. But here's the other thing I want to show you. This is a paper. It was published in 2010 by Dr. Fowl, and it actually had to do, as you can see from the title, with international perspective on the safe withdrawal rate. But I want to show you a chart that I found fascinating, relevant to our topic. Here it is. I'll make it a little bigger. So what he did was he went back in time. Again, we're looking at history. And he said, okay, with the benefit of hindsight, what would have been the optimal stock bond allocation? He also included bills or cash. What would be the optimal asset allocation to achieve the highest safe withdrawal rate? And as you can see, for many years, it was 100% stocks. That would be the columns that are all red. But for most of the years, you see some green and some purple, which are bonds and T-bills. And so for most of the time, you need some allocation to fixed income. But how often was it optimal to have only 20 to 50% in stocks, or put another way, to have 50 to 80% in bonds? Well, not very often at all. In fact, you have to go back again to our friend, the stock market crash in 1929. That's that green bar here that goes all the way down. But even there, you're only at 75% bonds. At no time was the optimal allocation 80% bonds. And there are only a couple of years, basically 3 here, where it was ideal to have 50% or more in bonds. Only 3 years out of the last, he looked at 80 years, because that's the data he had. He published this in 2010 and was looking at 30-year retirement periods. So only three years out of 80 was the optimal bond allocation north of 50%. So I suppose one way to look at that is to say, well, Rob, it happened before, it could happen again. Absolutely true, but highly, highly unlikely. I guess, time will tell. If we're still around doing YouTube videos 30 years from now, maybe one of you will remind me about this one, and we'll go back and figure out what the optimal asset allocation was. I can tell you, for me, it's hard for me to conceive of something that would cause me to go below 50% in equities, but that's just my take. And in any event, based on their models, they're saying the ideal allocation is equities of 20 to 50%. So that was the next finding that I found fascinating. The third thing, we talk about return assumptions. They have this model that they use, as I mentioned, and of course we have high stock valuations and low bond yields, and so that's given them sort of a lower expected return over some number of years in the future, and that then feeds into their mean and standard deviation that they put into their Monte Carlo simulation. But I found this section interesting because they said, look, if we just used history and pulled out the return averages and inflation averages and standard deviation based on the historical record and ran that through the simulation, the 3.7% shoots up to, it's right here, 5.5%. That's with a 50-50 portfolio, and 5.7% with a 60-40, 60% stocks, 40% bond portfolio. And boy, that's a big, big jump. You're talking, 2% there increase over the 3.7% that they found. So a very significant difference. And I do think it raises some questions for us in or near retirement. What kind of assumptions should we be making about returns in particular? For example, in retirement planning software like Bolden or Projection Lab or Prelana, one of the things you might try if you use software like that, or you can talk to your financial advisor if you have someone helping you, is to say, hey, let's run some simulations where we assume a much lower than, I'll say normal or historically normal returns, say for the first 10 years of retirement. You can do that in tools like Prelana and Bolden. Or your financial advisor can certainly do it. Let's assume the first decade of retirement, that the average returns on stocks and bonds are whatever, 2 or 3% below what the history would tell us they should be, and see how our retirement plans, sort of stress test your retirement plan. Because boy, when I saw that difference, I knew it would be higher than the 3.7, but I was surprised to see it jump by 2%. So something to think about as you're doing your own retirement planning. So that was the next thing that caught my attention. Now, I alluded to this earlier, but this is an important chart. Remember, I told you that they assumed a 90% success rate in their Monte Carlo simulations. And you see these success rates. I've done past videos on them, again, with Projection Lab, Prelana, Bolden. And at the end of the day, you have to decide what level of success rate you're comfortable with. One of the things I think about is, first of all, how much flexibility do I have? Because I don't really think of this as a chance of failure. I don't think any of us are going to, literally run out of money. I don't think. What we'll probably do is cut back, right? If things aren't going well in the market or inflation is high, we'll do our best to cut back. But that raises the question, well, how much flexibility do you have in your budget to cut back? And so that I think is a big consideration in deciding, what level of success you want in your planning. The other thing would be, how conservative are you in the assumptions you're making in your plan? Maybe the more conservative you are, the lower the success rate you might be comfortable with. At the end of the day, we have to each make that decision for ourselves. But I point out this chart because what they do is they have the different asset allocations on the left. These are all equity weighting, so you have 100% equities here all the way down to effectively 100% bonds at the bottom, and then success rates from 50 to 100%. The thing that I noticed is that when you go from 90 to 100%, the safe withdrawal rate drops like a rock. I mean, it just folds, 3.7 to 2% on the 50-50 portfolio. But as you go down, it doesn't. It jumps up. It goes up, but not as much. I mean, you kind of wish it went up as much as it went down, but it doesn't. But still, a 3.7% safe withdrawal rate at 90%. You jump to 4.2% at 80% if you're comfortable with that. I mean, that's a pretty big jump. That's $5,000 on a $1 million portfolio. So certainly a lot of money. So I wanted to show you that. I think this is a good chart that they put in there because we each have to decide what success rate we're comfortable with. Okay. The next thing, they have a whole section on dynamic spending strategies, withdrawal strategies. All dynamic means is you're not simply adjusting your spending each year by the rate of inflation. So the base case is here. That's the Bill Bengen approach, effectively, where they adjust spending each year by inflation. And as the blue dot goes higher, the safe withdrawal rate goes higher. So you can see the scale here on the left. So this is the 3.7 we've talked about. And they look at four different, I guess we'll call them dynamic withdrawal strategies. One is actual spending. And you say, well, what is that? So the idea here is that we don't spend the same amount of money on an inflation-adjusted basis every year in retirement. Studies show that even factoring in healthcare, we tend to spend less as we age. And so given that, if we want to sort of bake that assumption into our planning, we can actually start with a higher safe withdrawal rate because on an after inflation basis, we'll be spending less when we get into our, say, 80s and 90s, even factoring in for healthcare expenses. And so the safe withdrawal rate jumps about 1%, it looks like. They have three others. They have foregoing inflation adjustment. The idea here is you won't do an inflation adjustment in any year where your portfolio declines in value. So if just imagine in 2025, your portfolio went down in value, when you set your spending for 2026, you'd keep it the same. You wouldn't adjust it for inflation. And so that bumps up the initial safe withdrawal rate a little bit. I wouldn't say a lot, but to about 4.2%. They have other charts, by the way, in the paper that actually put numbers to all of this that you can check out. Now, you'll notice the dot, though, they move it to the right. And what we have down here is a scale for standard deviation. What this is trying to measure is the variability in your spending on an after inflation basis from year to year. And so here, the variability, I wouldn't call it significant. It's a standard deviation of 5. So there's some variability. I wouldn't call it significant. But when you get to guardrails and RMD approaches, you can see the variability gets pretty significant. I would say even extreme in the RMD case. Guardrails we've talked about, Guyton-Klinger guardrails are an example, but it's where you start with a higher safe withdrawal rate. In this case, it looks like it's right at 5%. But you put guardrails such that if, because of the market and inflation, your spending as a percentage of your portfolio goes too high, you cut back. And maybe the market's doing well and inflation's low, so your withdrawal as a percentage ends up falling low. You can increase it. That's sort of the idea. And so you can start with a higher safe withdrawal rate, but you may have to cut back, and that's why the standard deviation is so high. You can see fluctuations in your spending. And then this just follows the required minimum distribution approach. And you can see that the variability gets quite high here. One thing I'll mention in this paper, I won't go through it all for you, but you'll find it there, is they do a good job of saying, okay, depending on which dynamic strategy you choose, here's how much you'll spend over a 30-year retirement, and here's how much you'll have left over. Again, these are based on projections and a lot of assumptions, but you'll see that there's always a trade-off. There's a trade-off between how much money you'll have to spend, how much money you'll have left over, which may or may not be important to you. But then the third thing is that variability. And so there are a lot of charts in here that I encourage you to read if this is a topic you want to study in more detail, that really do a good job of walking through the comparing and contrasting these strategies. I will say, as a practical matter, when I talk to people that are retired, most people that I talk to actually follow the RMD. What they do is they take their Social Security and then they spend that. Maybe they have a pension, they spend that, of course, and then they take their RMDs, and that's what they do, and that's what they live on. So this RMD plus, I'll call it plus Social Security, maybe plus pensions, I think is a very, very common strategy in retirement. All right, the last thing I want to mention is they go through a whole section on guaranteed income, and they look at a couple different sources. Social Security, they look at tips ladders, if you can see that right down here, and they look at immediate annuities and deferred annuities. And there's an important point here. Remember I said that with dynamic withdrawal strategies, there can be variability depending on which one you follow. But the better question isn't what's the variability of a specific withdrawal strategy. It's what's the variability of your income when you factor in all sources of your income. So not just, say, an RMD strategy or a guardrail strategy for pulling out your savings, but also Social Security, perhaps a pension if you have it, annuities if you have it, and so on. Because particularly with Social Security, it's adjusted for inflation. So when you combine Social Security, which adjusts for inflation and so has effectively no variability of spending from year to year on an after inflation basis, with something like an RMD that has a lot of variability, when you combine those two, the stability of Social Security sort of softens the blow, if you will, of the variability with RMDs. And so they go through a lot of that in this section of the report. I think it's very useful depending on your specific circumstances. They look at their base case is you wait until 67, right? I can't highlight it, but right here. You wait till 67 or full retirement age to claim. But they also look at claiming early and claiming late. The without a bridge and with a bridge, the bridge simply refers to, do you have some source of income that you can rely on outside of your retirement savings to fill the gap of Social Security while you wait until age 70 to claim it. Some examples might be a spouse that's working, maybe you have a part-time job, I think they use rental income from a property you might own as an example. But they look at those two options. And then they look at guardrails with Social Security. And then they look at tips ladders, which I think is interesting. They walk through that. And then they look at immediate and deferred annuities. And so I think this is an important section to focus on because it really gives you a more holistic view of what retirement spending will look like for the vast majority of people. It's not just our retirement savings. So there you go. Again, I kind of just walked through the highlights. It's a 43-page report, so there's a lot more that I didn't cover. But I found the report to be extremely valuable. Again, it's not going to be valuable in the sense that you'll follow it to the letter and come up with some plan based explicitly on what they're saying, or that you'll even follow their safe withdrawal rate. But I do think it can show you how different metrics and different assumptions can change the results. It shows you the impact of combining different withdrawal strategies with different sources of guaranteed income. And I think all of that can be useful in coming up with a retirement income plan that works for you. So there it is. Again, I'll link to it below the video. If you have any questions, leave them in the comments below. I'll be happy to help you out any way I can. And until next time, remember, the best thing money can buy is financial freedom.